correlation swap like a simple bet on how closely different assets move together. Instead of betting on whether prices go up or down, we're betting on how synchronized they are. One side agrees to pay a fixed correlation, say 30%, and the other side pays whatever actually happens in the market, called the realized correlation. So if stocks start moving tightly together, the buyer wins, and if they move more independently, the seller benefits. Now imagine two traders shaking hands on this number. They agree on a fixed ROE of 0.30. The buyer pays this fixed value, and at maturity, the seller pays the realized ROE. At the end, nobody exchanges both amounts separately. Only the difference matters. So the trade really depends on just one thing: realized minus fixed. It works exactly like an interest rate swap, except instead of swapping interest rates, we're swapping correlation risk. But how do we actually measure this realized correlation? First, we collect daily returns for each asset, say R1, R2, R3, up to Rn. Next, for every pair of assets, we compute the pairwise correlation using the formula ρ_A_E equals covariance of ρ and ρ divided by sigma_I times sigma_j. After that, we count how many pairs exist, which is n times n minus 1 divided by 2. Finally, we average all these correlations. Mathematically, realized correlation equals 2 divided by n times n minus 1, multiplied by the sum of all ρ_ij terms. In simple words, just take the average of all pair correlations. Let's see a quick example. Suppose we have three assets. The correlations are 0.6, 0.2, and 0.04. Since there are three pairs, we add them and divide by 3. That gives us 0.28. So the realized correlation is 28%. Now comes the payoff, and this part is beautifully simple. The formula is payoff equals notional times open bracket realized minus fixed close bracket. Imagine the notional is $1 million. The fixed rate is 20%, and the realized correlation turns out to be 28%. The difference is 8%. Multiply that by 1 million, and the buyer earns $80,000. But if realized had been 15%, the buyer would lose $50,000 instead. So you're basically trading the gap between expectation and reality. So why do traders even care about correlation? Because during market crashes, stocks suddenly move together. Correlation shoots up, diversification disappears, and portfolio risk explodes. To protect against that, managers buy correlation swaps as a hedge against systemic risk. Others use it to speculate. For example, they might buy index options and sell single stock options, because when correlation rises, the index becomes more volatile than individual stocks. In the end, remember this: a correlation swap is nothing more than trading how tightly assets dance together.